The bad news is that even the Fed has escalated to a very hostile and aggressive position. The good news is that data are starting to come in that support the fact that the US economy is in a recession. If you've listened to us before, you know that we think China and Europe have also been experiencing a recession for some time, making this a truly global recession. Additionally, there are many signs that prices are declining. So I believe that the assumption that everyone has been worrying about inflation is a misguided way to see the world at the moment. We have been warning for a while that deflation is a much greater risk than inflation, and we have received criticism for it. People who were convinced that inflation was returning to the 1970s challenged us on our position. We believe that due to the pricing behavior, I'm not just talking about stock and bond prices, I'm talking about commodity prices, cryptocurrency prices, and possibly even soon housing prices. Many people will come to the conclusion that the greater risk is deflation, even though, as you know, we don't necessarily believe that deflation is a bad thing. We think that the way the Fed has handled it is wrong. Although we anticipate seeing a lot of deflation brought on by technology and advancement over the coming years, the deflation we are currently seeing is not healthy. The Fed is no longer in its quiet time, so all Fed governors have been prancing around saying we're going 75 basis points, another 75 basis points. We're going to have to get through this because I believe the next Fed move is scheduled for the end of this month. We believe that they will change their minds this month when we receive additional pricing cues, as well as earnings report and guidance from businesses that will likely indicate that the United States is indeed in a recession. So good news and bad news. We believe that growth will be scarce this year, and as you are aware, growth is the foundation of innovation. Innovation is also about finding solutions to issues. And because we already have a lot of them, the current recession will add even more. It's noteworthy that the cryptocurrency market experienced its worst quarter since 2011, while being far more developed now than it was back then during the boom-bust period. The S&P 500 is down 20% so far this year. Nasdaq is down about 30%. Therefore, the stock market has not experienced a worse year to this point since 1962, when the Cuban Missile Crisis occurred. After that, the Great Society with its emphasis on guns and butter and rising inflation began, but before that, the stock market was a barn burner that was extremely hot from 1962 to 1966. In terms of bonds, this has been the worst year to date in anyone's lifetime. By certain metrics, you must piece together the bonds. But to attempt to break the record, it needs to be the worst since 1788, which is more than 250 years ago. Investors have faced a very, very difficult market. We believe there is hope at the end of the tunnel since the Fed is receiving several signals that will eventually be reflected in the lagging indicators such as the PPI and the CPI. Numerous indicators are coming in, and I believe many businesses will hint at the recession in their earnings reports over the upcoming month, and I think the Fed will pause when significant downturns occur swiftly. He reiterated what he said in Jackson Hole, basically that their twin mandate of jobs and prices has narrowed their attention to just prices. Although I think it's excellent that they're concentrating more on the pricing rule, I believe the pivot will be brought on by the system's extreme deflation, which is currently occurring. If you look at commodity prices, for instance, gold actually reached its peak in August 2020, and it's currently trading at the low end of a 2-year range, while copper, oil, lumber, iron ore are all falling, indicating that supply chains are becoming significantly more flexible and rates are decreasing. As a result, there is deflation in the system. To combat this, Volcker needed a sledgehammer, which is what I believe he needed to do in the early 1980s, when I was just starting out in my career, and inflation was already deeply ingrained in society as a result of 15 years of extravagant spending on the Vietnam War and the Great Society. Chairman Powell believes he needs, but given how much inflation there is right now, we don't believe that to be the case. Additionally, we see a significant inventory overhang around the world due to the global economic downturn. China is effectively in a recession, and retailers in the United States have a surplus of inventory that must be cleared through discounts. As a result, we anticipate some significant downside inflation surprises over the course of the next 3 to 6 months. The PCE deflator is being examined by the Fed. It peaked in February at 5.3%, is now at 4.6%, and we think some bad news has already been reported. Nobody believes them, but we do. We anticipate seeing more negative data over the next 3 to 6 months, so we wouldn't be shocked to see it well below 3 in that time frame, if not below the 2 handles. And if we experience enough consecutive drops, I believe the Fed will drastically alter its course.
Let me know in the comments if you have any other questions about investing. Let's return to the video.
The Fed will likely be looking at the sequential data, many of which will be negative, which will inspire them in my opinion. I believe they will change their tune and maybe accept interest rates of 75 basis points this time, but the next time 25 to 50 basis points, and then after that we shall see. Until some of these cost decreases are achieved and stocks are cleared, we believe profitability will be severely constrained. We currently do not believe that this will resemble 2008 or 2009, as many people fear. Rather, we believe that it will be more of an inventory recession and a drag on the rest of the world. Energy prices are crushing Europe, while China is readjusting to the conventional view of prosperity. Since there has been much denial about the recession we are in and the fact that it will end next year, as opposed to what many experts are predicting, I believe it will be more of an inventory recession. As a result, I believe the market will be improving as we end this year. We do believe that there has been some labor hoarding in this situation. Although the employment numbers have appeared to be strong, if you peel back the layers, you will find that household employment, which includes many small businesses, has been essentially flat over the past 4 to 5 months. This is where we are currently experiencing the majority of the pain. I wouldn't be surprised to see us reach a 6% unemployment rate. I do believe the inventory recession will be slightly sharp and will raise the unemployment rate. But the labor hoarding is due to companies' inability to find workers during the supply shock and COVID. So now that they can, they're holding a bit longer than I believe they would normally. As with other growth strategies, ours has been severely harmed by concerns about inflation and rising interest rates. But as I stated, we anticipate a turnaround. These 5 platforms, which are 5 innovation platforms, and have exponential development trajectories, are where we observe the growth. Furthermore, we have encountered numerous problems with COVID-related comparisons in equities, like Roku, Teladoc, Zoom, and so on. Therefore, there has been a lot of misunderstanding in the market due to relatively short-term indicators. But the tremendous rise is real. It has already occurred, and we believe it will continue. We see that today's truly disruptive innovations, on which we solely concentrate, are valued at about $8 trillion in the worldwide public equity markets. In the next 8 to 10 years, we predict that number will increase to more than $200 trillion, representing 60% of the global public equity market, up from the current level of less than 10%. And the reason we think it will get to that level is that these platforms will upend the established world order in a way that has never been seen before. Telephone, electricity, and the automobile upended the traditional order of things in the early 1900s, but we were not alive at that time. These are 5 platforms, not 3, and they incorporate 14 distinct technologies. So if our predictions about the state of the economy are accurate, and inflation is about to decline significantly, that will be really beneficial for our growth stocks. When we see a compression in performance, We focus our holdings on the companies with whom we have the greatest conviction, reducing the number of companies in our flagship strategy from 55 to 33. We performed the same thing during COVID, but the payments was just for 1 month, and it was extremely painful. From COVID's lows, we rose by 360% in less than a year, so that was probably ahead of its time. Given a 5-year investment time horizon, we have had a significant correction and currently have a large number of stocks that I would classify as deep value stocks. But I'll say right now that the market and the 2-year treasury both price in at least 4 interest rate increases. The financial markets are rapidly pricing in this eventuality, and rising oil costs would actually be a hefty tax on our economy's lowest socioeconomic and demographic groups. Since inventories are building up across the ecosystem, I believe that the anxieties in this area will change from rising interest rates and possibly greater inflation to recession in particular. You may have heard me mention this previously.
Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching. Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.